Welcome back, business law students. Today we're going to talk about insurance. And first, let's put this in context. Whenever you're a manager, it's incumbent upon you to consider risk management, and there are various ways to do it. For example, in international transactions, you might want to do currency hedging. If you're getting paid for us in the US, non-US dollars, for example, you might want to buy forwards, contracts, or whatever other things to make sure you don't lose money in the currency transaction. When we're having multiple manufacturing locations, sometimes that is a risk management technique. If one were to be destroyed, you can shift a certain amount of production to the second plant. There's a lot of different risk management methods, but one of the primary is insurance and covering adequate insurance for your facilities, which is an incredibly expensive proposition. But indeed, it's if you're doing your due diligence as a manager, that's one of the things you have to consider. So first, let's look at some terminology. That's unfortunate. There's just some things we have to memorize and think of when we are um, working on insurance and for you to understand. Let's go over those pretty quickly. Policy, I think you all know what the policy is, but it's important in business to recognize that whatever coverage is uh, provided to your company, it is construed by the policy, and they are replete with exceptions, if you will, exemptions from coverage. And so you always want to check that throughout the policy. Premium, of course, is what you are paying. There's also an underwriter, and that basically is the person or company, and they evaluate risk. So a lot of insurance companies will have underwriters that assess risk. Gee, what should our rates be for this person in this industry, et cetera, et cetera. Now let's look at a video because there's a distinction between an agent and a broker in insurance. And I think it's important that you understand the distinction. So let's do a little share here. Bear with me.
What is the difference between an
Thank you for your patience.
What is the difference between an insurance agent and a broker? One thing that everyone in the insurance industry agrees on is that clients should seek professional advice to ensure that they are getting the proper coverage at the right price. If you ask anyone outside of the insurance sector this question, they will most likely react with their own, "What's the difference?" It is safe to assume that the majority of individuals do not understand the distinction between an insurance agent and a broker, and frequently use the two names interchangeably. The truth is that there are substantial distinctions between the work of insurance agents and brokers. What is the role of an insurance agent? Let's start with the fundamentals. A person who acts on behalf of another individual or organization is known as an agent. An agent in the insurance industry represents one or more insurers. The agent is in charge of distributing the insurer's products, which are insurance policies. They may represent a single insurance company or multiple. Agents operate as mediators, giving information from the insurance business or companies they represent to potential buyers. They have contracts with insurers that outline which policies they are permitted to offer, and how much money they may expect to make from doing so. One of the most important components of what makes an agent is their ability to bind the insurer, because they represent the company. Insurance agents are classified into two types. Agents in captivity. Captive agents operate full-time or as independent contractors for a single insurance business. They may receive operational support from the insurance company that hires them, such as an office or administrative personnel. They frequently receive referrals and leads on potential clients from the insurance. Because captive agents exclusively sell insurance products from the insurer they represent, Captive agents are extremely informed about those products. Agents who work alone. Independent agents deal with a variety of insurers, and because they are not bound to a single business, they can frequently offer a broader range of insurance products. This means that they can provide insurance firms with a broader distribution network than captive agents. Independent agents will be authorized to price and issue insurance policies on behalf of the insurers they represent, mostly through the systems of those insurers. Customers can use the systems to access specific insurance types, pricing models, and support tools. These agents may provide their customers with additional services such as claims help, a review of other insurance policies, and guidance. They are quite similar to insurance brokers, however, because their obligation is to the insurer rather than the client, there are limitations to what they may give a client. What is the role of an insurance broker? A broker is an insurance specialist who legally represents individuals or organizations wishing to purchase insurance. In some areas, insurance brokers have a fiduciary obligation to their clients, which means they are compelled by law to operate solely in their clients' best interests. A broker will work with their clients to find and create the finest insurance plan for their unique coverage requirements. They are not required to sell plans from one insurance company or another, which means they can search around for the best coverage at the greatest pricing based on their clients' needs. When a business hires a broker, it may expect to be guided through the full insurance purchasing process. There are also other types of brokers. Brokers in retail. A retail broker is the one who works the most closely with the client. Retail brokers can help their clients identify the correct insurance to buy, either directly from an insurance business or from wholesale brokers. Retail brokers typically engage with less complex insurance products that cover ordinary hazards. Brokers in bulk. Wholesale brokers offer a broader range of insurance products. These insurance products are sold to both retail brokers and insurance agents. A wholesale broker does not need to contact or work with clients in order to understand their needs. Brokers of surplus lines. When a client's insurance demands exceed what the conventional or admitted market would insure, he or she may need to turn to surplus lines or non-admitted insurers. A properly licensed surplus lines broker is required for this. Brokers of surplus lines might be retail or wholesale. It is a customized license that allows access to specific insurers with more specialized policies or risk tolerances.
All right, so basically, in my opinion, the most significant thing about that distinction is if you're a medium to large size company, you're going to usually work with a broker. And then when you do renewals every year, you'll probably put your business to market. In other words, your broker is if something's negative to one insurance company versus another, they can tell you. They also have a duty towards you. So they're working in your best interests instead of the interest of the insurance company. An agent might be selling you insurance. I'm not saying that's bad, but as a broker, it's almost always the best to receive good advice from a broker as opposed to an agent. All right. Continuing with insurable interest, I think you know what life insurance is and you know what property insurance is. When you're working with your company, you probably won't you will be concerned with life insurance usually in only two instances. And number one, what insurance options you might be providing to your employees. If that's one of the insurances you provide, life insurance often, uh, well, it depends on your company, but often they'll pay a higher cost. And then sometimes you will have what's known as a key man insurance. Or so for example, if you're in a tech company and there's two or three executives that really know the technology or really have grown the company, et cetera, your company might actually have life insurance on those individuals. Also, if you purchase a company from and there's a key man or key men, and that's non-gender specific, the term is key man, then you would go ahead and not only try to keep those people on with a consulting agreement of some sort for a period, transition period, or maybe long term, but you might also want to place life insurance on them. Now, when you're doing a key man, life insurance, the proceeds, if and when they pass away, is not going to their spouse. It's going to you, the company, because will have a business loss. Now, there's another interesting concept called insurable interest. Who can buy insurance? And for example, if I wanted to bet on when back in the day, if I wanted to bet on when Elvis was going to pass away decades ago, uh, if conspiracy theorists are correct and he's not working at a 7-Eleven somewhere, then I couldn't get a life insurance policy on him because I don't have an insurable interest. His wife could have, and his children could have done so. If I were doing it, that's gambling, not an insurable interest, not an insurance issue. Let's look at another fairly quick video that covers that as well.
I deposited $400,000 from my life insurance policy into my check.
Welcome back. In this video, we're focusing on a critical concept in insurance, insurable interest. Understanding this principle is not just essential for passing your pre-license exam, but also for understanding the ethical and legal foundation of insurance contracts. Let's start with the basics. Insurable interest refers to the financial or emotional stake someone has in the continued well-being of a person or the preservation of property. Without it, insurance could become a form of gambling, which is against public policy. Insurable interest exists when the policyholder stands to suffer a financial loss if the insured person or property is harmed. Let's look at some examples. For life insurance, a spouse, parent, or business partner typically has an insurable interest in the insured. Property insurance, the owner of a home or car has an insurable interest in that property. Now, let's consider what doesn't qualify as insurable interest. A stranger taking out a life insurance policy on someone they don't know, someone trying to insure property they don't own or have no financial stake in. These situations are often classified as wagering contracts and are both unethical and illegal. For life and health insurance, insurable interest must exist at the time the policy is applied for. After the policy is issued, it doesn't matter if the insurable interest changes. For example, a divorced spouse can still collect on a life insurance policy even if they no longer have a financial relationship with the insured. For property and casualty insurance, insurable interest must exist at 2 points: when the policy is purchased and when the claim is made. This ensures that only those with a legitimate financial stake can benefit. Here's an example. Sarah owns a car and insures it. She has insurable interest because she would suffer financially if the car were damaged. However, Sarah can't insure her friend's car because she doesn't have a financial stake in it. A special topic related to insurable interest is stranger-originated life insurance, or STOLI. This involves investors encouraging individuals to purchase life insurance policies with the intent of transferring ownership to the investors. STOLI arrangements bypass the requirement for insurable interest and are prohibited in most states due to their unethical nature. Exam tip: be prepared to identify scenarios where insurable interest exists and where it does not. Pay attention.
All right. Relax, that exam tip doesn't apply to you. That's for the intended audience for that video. So, insurable interest. For whom and what can you insure? Right. Next concept, and again, we're talking about insurance this week, is let me just show you some typical insurance contract provisions. And these are those that the text found to be of significance for you. Anti-lapse clause. Okay. So let's say, for example, your payment is 3 days late because it was delayed due to a storm. Well, there's probably a clause that says you've got some sort of a grace period for it to continue. Appraisal. Well, if you have a loss and you disagree on what the value is with the insurance companies trying to lowball you, you can often get an independent, impartial appraiser to look at it. Arbitration. All right, we're testing your memory. Let's go back to when we were talking about litigation, and there are alternative methods of resolving disputes. One was mediation, which is getting together with a mediator, and if you voluntarily agree to settle it, so be it. Arbitration is like a trial with a judge, but it's not a judge. It's confidential. It's not public filing like a trial would be, and it's usually faster. Most insurance contracts will have that clause requiring you to submit to arbitration in their jurisdiction. Delaware, wherever it happens to be. Co-insurance, I'll let you read that, but basically, for example, when you buy a house, your bank, if you borrow money for the house, the bank is going to make you do insurance up to such and such level. Incontestability, uh, we're not going to run across that one. And multiple insurance clause, that's always in there because they'll say if you have like two different policies that cover the same one, then you've got to figure out who pays and how much. All right, we looked at that. Cancellation. This is some good thing to know. You as the insured, now who's the insurer? That's the insurance company. Good thing I can say my R's. The insured is you or your company who has insurance coverage. And theoretically, you can cancel at any time your policy. However, the insurer, once you have a policy from this date to this date, they generally are not allowed to cancel unless if it's auto, you get your license suspended or you haven't paid your auto insurance. For property, again, not payment, or in your application, you've committed fraud or misrepresentation. Gee, we're doing this, but then when the insurance company looks and you're actually storing hazardous explosives, well, that would have been fraud. And so they could cancel you for having misrepresented when they provided insurance coverage to you. Life and health, false statement on the application. Now, when you get now CGL, completed products, commercial general liability, CGL, completed products, basically the same thing. And in the US, we might call it a little bit different. In fact, we do. But there'll be two primary duties for the insurer. Now, you as the insured, obviously you have to be honest when you apply. You have to pay your premiums. You have to let them know of a claim within a reasonable time, which is very important, or else you might waive coverage to a certain extent, and then cooperate when they're investigating. But as far as the insurer, there are two major duties that the insurer has to you, and you need to remember this. One is the duty to defend. So basically, that's attorney's fees and them paying for attorneys if you get sued or there's a claim against you. In many instances, the attorney's fees can be more than the damages. So the duty to defend is a very important clause. And then the second, the investigate and then pay if you're liable. Let's look at a really quick video on that as well. Bear with me.
Liability insurance. Liability insurance is third-party insurance, which means it protects a policyholder from claims by third parties. Liability insurance provides this protection in two ways. First, the insurer defends the policyholder against third-party claims. Second, the insurer indemnifies the policyholder by paying the cost of claim judgments or settlements. In this lesson, we'll look at the first protection, the insurer's duty to defend the policyholder. Indemnity coverage is discussed in a separate lesson. Imagine a factory was sued for allegedly dumping hazardous materials on neighboring property. The factory had a commercial general liability, or CGL policy, that covered claims for the factory's negligent actions, but excluded coverage if the factory had caused harm intentionally. Did the insurer have a duty to defend the factory against the dumping lawsuit? In most jurisdictions, the insurer must defend the policyholder if the policy either covers or potentially covers a claim. Usually, when a claim is first made, the full claim details aren't known yet. Thus, coverage and potential coverage are commonly determined using what's called either the four corners or the eight corners rule. Under either name, this rule looks at what's alleged within the four corners of the complaint and compares those allegations to what's covered within the four corners of the policy. If any claim is potentially covered by the policy, the insurer has a duty to defend the policyholder unless and until that potential coverage is negated. Less commonly, the policyholder may use information outside the complaint to show potential coverage. Assume the complaint against the factory alleged only negligent dumping. The policy covered negligence claims. Thus, the insurer had a duty to defend the factory.
All right, so it's interesting because what we call plaintiffs' lawyers, those that represent people and companies that are making claims. Sometimes you see those guys on TV. If they're good, they will actually draft their complaint. And you'll remember a complaint is what you file in a court to start a lawsuit. They'll try to write it or draft it so that it invokes insurance coverage of the person they're suing. That way they know there are deep pockets because they've got insurance coverage. Okay. Now, if you're in the insurance company, what are some of the defenses against payment? Well, we discussed before if fraud or misrepresentation, when you apply for the policy or misstate something to the insurance company that's material, important, they might say we don't have a duty to defend because we thought we were insuring risk A and it's really risk B. Lack of an insurable interest, now you know what that is, or illegal actions of the insured. You notice in the one video it said negligent actions were covered, but intentional actions were not. So, for example, if your plant is operating and it has to use some hazardous chemical for the processes, cleaning, whatever, this seeped out accidentally through a pipe that corroded, then hypothetically that would be covered by insurance because it was a negligent act. Conversely, if your one department that was in charge of waste took those hazardous chemicals and just dumped them on your neighbor's property, that may well not be covered because that's an instance of something being intentional instead of being negligent. Now, a final note about some of the types of insurance that you'll run across in your business having to do with your products. Well, you saw the CGL, commercial general liability or products liability. It's the same policy, whatever you call it. Has to do with people suing you. Sometimes you'll get an umbrella policy. So let's say you've got $1 million of coverage on your policy, but some customers require you to have 5 million, for example. Well, then you buy another 4 million for a total of 5. And that's excess coverage, or what's often called umbrella, because it covers the underlying insurance. Now, if you are a service company, for example, architects, engineers, etc., you will probably also have professional liability or errors and omissions insurance. It goes by different names, but essentially it covers the services, representation, professional services that you provide. So that's not a product, that applies to professional services. Now, when we get over to the employee benefits that you may provide, then you get into health insurance, unemployment insurance, mandatory to buy, workers' comp insurance, mandatory, uh, health insurance, if I didn't say that already, that you may be providing, and in some instance, options for life insurance to employees. All right, that's the major categories. I know we've done it quickly, but that's it for insurance, and I'll talk to you next time. Thanks.